Have you ever heard the phrase, a rupee today is worth more than a rupee tomorrow? It's not just a saying, it's actually one of the most important ideas in finance.
In this short video, we will explain what is time value of money, how businesses use it, and what logic behind it. So what is time value of money? Time value of money means that money you have today is more valuable than the same amount in future. So because you can invest it and earn interest.
For example, if you invest 1000 rupees today at 10% annual interest, you will have 1100 rupees in future. That's why we say money has time value. It grows over time.
So how time value of money is used in the business world? In corporate finance, managers take key decisions based on this time value of money.
It helps calculate the value of future cash flows, investments, loans, bonds and shares. Basically, time value of money supports all financial planning and decision making in a company.
There are two perspectives of time value of money. The first one is investment perspective. This means how much will my money grow in the future. Other perspective is financing perspective. That means how much a future money worth today.
These help both investors and financial managers decide when to invest, how much to borrow and what returns to expect.
Now we are going to talk about the simple interest. Simple interest is the money you earn or pay for borrowing or investing money over the time.
It is calculated only on the original amount, not on the interest that has already been added. Simple interest has two parts. First one is present value and other one is future value. So Naduni, can you tell me about future value?
Yeah. The future value of the present cash flow means how much your money today will grow into the future after earning interest over the period of time. So there is a way of calculating future value. So the formula is,
the second one is the present value of the future cash flow. It means how much future money is worth today. It helps you to understand the value of expected income in the today's term using certain interest or discount rate. The formula is, we can calculate.
Hey Jaini, how does compound interest relate to the time value of money?
Alright, let's talk about this. When we talking about the time value of money, we cannot forget compound interest. For a single period, compound interest means you earn or pay interest on the initial amount for that single period. With single cash flows over multiple period, compound interest means you earn or pay interest on the interest including initial amount, which means the initial amount will grow faster as there is interest on the interest. Let's talk about future value and the present value. Future value reflects how much money will grow in the future when adding interest on the interest. Present value tells us the worth of a future amount as of today. Simply, you can calculate future value and the present value by these formulas.
Ever wondered what a future sum of money is worth today? That's what we are talking about with discounting. It all comes down to a simple formula. Let's use an example. Think you get 25,000 rupees in 3 years and interest rate is 10%. You'd find that today that same amount of money is only worth about 18,787 rupees. Take it this way. Money today is more valuable than the same amount of money in future. So we are basically discounting the future value of money to find out its true value right now.
So compound interest. When you come to compound interest, there are two parts of compound interest. Single cash flows, multiple cash flows. So now you know about single cash flows. So let's talk about compound interest with multiple cash flows. calculate the future value or present value of the cash flows using compound interest. This is the definition of multiple cash flows with compound interest. There are two key formulas: future value, present value. Hi Macha, Wazim.
Hello Tik.
So what do you know about annuity, Macha?
Annuity. So a series of equal payments made at regular intervals. There have two types of annuity: ordinary annuity and annuity due. Can I give the common example, Tik?
Yeah, sure, Macha.
So paying off a car loan with a fixed monthly payment, that also some kind of annuity payment. They're receiving a monthly pension after retirement, also a kind of annuity payment. There I have two type of formula for that: present value and future value.
Hi, we are here to talk about perpetuity. So let's talk about what is the perpetuity. Perpetuity is a series of equal cash flows received indefinitely. It assumes the payment will never end. So commonly in valuing preferred shares, trust funds and scholarships. This is the formula.
Do you know why the time value of money acts a huge role in loan amortization? Money has a high value in future than the present. That's why you pay a high interest at the beginning and a low interest at the end. So in a way, loan amortization respects the value of money as it changes.
Wow, that actually makes a lot of sense now, Vishnu. This is simply loan amortization is.
Now I am going to explain how time value of money concept used in Commercial Bank of Sri Lanka. According to my research, the Commercial Bank of Sri Lanka applies the time value of money in several areas, especially in loan pricing and the investment decisions. For example, in 2024, their loan portfolio grew to over 1.53 trillion rupees before approving a long-term corporate loan. The bank discounts the future prepayments to today's value to make sure the interest rate covers their cost and generate a return. The same principle is used for fixed deposit, which total 2.31 trillion rupees, to calculate the exact maturity value for customers. So, the bank also considered time value of money essential for long-term investments. In 2024, Commercial Bank managed 2.88 trillion rupees in total asset and funded projects in renewable energy, infrastructure and technology. They evaluate whether the future cash inflows from these projects are worth more than the initial investment today, after accounting for inflation, risk and the opportunity cost. This careful approach helped them achieve a return on equity of 22.06% and a return on assets of 2.01% in 2024. The bank uses techniques such as net present value and internal rate of return to approve major projects. For example, in a renewable energy financing projects, they calculate the net present value of expected repayments and check if the internal rate of return higher than their required return, which is linked to net interest margin of 4.27%. Because the results were positive, the project was approved. The Commercial Bank also applies the time value of money in its risk management process. With a CASA ratio of 38.07%, they enjoy low-cost funding but still ensure that their loans and investment generate a positive present value after considering risk and cost. This helped reduce stage 3 impaired loans from 5.85% to 2.76% in 2024.
So remember, a rupee in your hand today has more power than a rupee in the future. That's the time value of money.